Welcome back to another edition of the Investor Guys podcast. Bill, how you been?
I've been good, brother. It's been running like crazy. Real estate here is still hot. More opportunities coming up as things start to soften in other areas. And we get more and more. We're still having a gazillion people, just like you guys are in Florida. Texas is still having a ton of people move in every month. So our market is staying hot, saturated. There is very little inventory. And so the market's staying really, really good and still doing rental property in other parts of the country. And one of the things that, Kev, I want to talk about today is something near and dear to your heart, because it's what really broke you out, so to speak, in the real estate investment world, and that is commercial real estate. And so I want to go over some facts and figures, what's going on. And then I'd like you to tell everybody about that first big deal you did in commercial. And that would be one heck of a deal today. And that was what, 25, 30 years ago?
We actually covered that on a show not too long ago when we talked about the deals that stuck in our head.
But talking about commercial today, it might be a good refresher for everybody to hear that. I was looking at some things. There's a Benzinger report that has some really good real estate information. As you know, you and I both follow all kind of real estate information to make sure we're staying on top of what's going on, not only in our market, but what's going on nationally, because we invest nationally and not just locally. And I was looking at this report. It's written by a lady named Margaret Jackson, who really writes some excellent coverage of the real estate investment world. And she does it from a lot of different angles. This was really about commercial property. And the commercial market is getting hit, is going to continue to get hit. And there's going to be some incredible opportunities commercially. So Margaret wrote that with nearly $1.5 trillion in commercial real estate debt coming due between now and the end of 2025, so in the next 18 months, a lot of commercial owners are kind of wondering what's going to happen, where they're going to go to be able to borrow money. And a lot of them are still paying interest rates that are way lower than what current rates are. And when they go refinance those loans, if they can get them refinanced, they're going to have a significant increase in interest rates. JP Morgan recently said they will be debt constrained, meaning commercial real estate investors. They will be debt constrained when it's time to refinance. And this is from Victor Whitmore, who is the founder and CEO of Precision Equity. And he says $170 million real estate investment firm. That's what he runs, at Precision Equity. And he said, when loans are due, you either sell the property or refinance the debt. A growing number of investors, bankers, and economists are warning that in this commercial sector. Now, let's make sure we carve this out for everybody listening. The rental market, the apartment market, is not what we're talking about here. We're talking about malls, strip center, office building, warehouse space. That's what we're talking about when we talk about the industrial or commercial piece of the market. It does not include apartment buildings. Okay. The growing number of investors, bankers, and economists are warning about this, that people that own those type properties, if they're having to refinance, they're going to have a significant downturn in that market, and it's all based on interest rates. And so lower property values and higher vacancy rates, all those are going to play into effect, because what's going to happen as interest rates continue to rise, and we know with the insane economic policies that have been going on through this administration and have no signs of slowing down whatsoever, and the turn of the economy, with the crushing of the fossil fuel industry, which is crippling our nation, and is what drives inflation. So when this is going to continue, and as it does, and as these notes become due to refinance, which in the past, these guys wouldn't have blinked. They've just gone in with their bank, refinance, and life goes on. But now what's happening is when they look at those numbers, they go, wow, now I'm going to be operating in the red, can't afford to do that. But there's another piece attached to that, because rates are going up, vacancy rates are getting higher as well. When vacancy rates go up, the values of the buildings go down. So you've got this trifecta happening here. The buildings are producing less income because they're having to raise rents. Vacancies are going up because of that fact. Now their debt's coming due. When you look at a property, commercial buildings are not like going out and looking at a house. You don't pull comps and go, oh, gee, here's what the house down the street sold for. Here's what sold. That's not how that works in the commercial world. You base everything on the income of the property. And that's what levels the playing field. That's what creates comps in the commercial world. You use that to say, okay, in this part of the world, prime, grade A, B grade commercial will bring in X number of dollars per square foot. And then you go look at, all right, so this building, don't care whether you like the building or not, don't care whether it's attractive or not, this building is bringing in great income or it's not. And the value of that building will be directly reflected on what's happening with the income of the property. So when you get rising interest rates, rents go up, increasing rents cause vacancies to increase, and those two things help push the value down. So we've got this trifecta happening on commercial property owners, and a ton of those buildings are going to be sold. A ton of them are going to be foreclosed on and sold at deep, deep discounts. So growing numbers of those people are very concerned about the interest rate market and the impact it's going to have on that entire commercial industry. Federal funds rate was zero not too long ago, and that allowed those loans to go out at a very low rate, 2-3%. Now that cost is at 5%. So when the cost of funds goes from 0 to 5, the reflective interest rates may go from 2 or 3 to 6, 7, 8. And for a lot of these people, they're operating on too close of a margin to make that work. Now, we're coming up on a break here, Kev. I didn't mean to hog that whole first segment. So when we come back, we're going to hear from Kev on this issue. Stay with us. We'll be right back.
Back in a sec.
You are watching the Investor Guys podcast.
The Investor Guys podcast will be back shortly.
Absolution X. Limited editions. Seek your absolution. Lifestyle apparel like no other. Only at absolutionx.com.
You are watching the Investor Guys podcast.
And we're back. And you know what? This actually plays into a topic that I've been covering this week on the other show that I do. And we've had a lot of people calling in and asking, is real estate investing dead right now because of the economy, because of the impending recession, because of the interest rates and everything else? And what I've been saying over and over and over again is no, it's not. In fact, right now is when you want to look at opportunities, because more opportunities are going to present because of all of those things. A lot of people see these as challenges, and yes, you can see it as a challenge, but challenges also create opportunities. And you need to look in your own particular market and see what those opportunities are going to be. When we're talking about commercial real estate, what's going to be beneficial in your market is going to be different than what's beneficial in other people's markets. Excuse me. For example, in a lot of markets across America, malls are being closed down. They're being bulldozed and turned into something else. They're being closed down and turned into self-storage facilities or anything else. Is it a good time to buy a mall that you can get a good deal on? Not unless you have an exit strategy. If you have an exit strategy and you spend some time thinking about it, then absolutely. One of my favorite offices that I had, I didn't own it. I actually rented it, but the neighbors that I had a technology company, and they kept taking on every available unit that came up so they could load them up with servers. And they just kept filling them up with servers and filling them up with servers and filling them up with servers. And the landlord loved them. The rest of us hated it because we couldn't renew our leases, because he was able to basically lease that space to him at a premium, and he didn't have a lot of traffic in and out of those units because they were just server spaces. So if you have an opportunity like that, if you see a situation like that where you know it's not going to matter what's going on in the new work from home, climate that we have, where office spaces are sitting empty because of it in certain areas, where retail is dying because of Amazon and Walmart.com and Target.com and everything else, then take advantage of those commercial opportunities. Can you use commercial space for something else? Absolutely. Figure out what the need is, figure out what the fit is. A lot of commercial spaces, especially first floor commercial spaces, and I'm talking office buildings, okay, have been redone. And I see that a lot here, redone to be retail and to be restaurant space. And when you've got people who do have to go into the office and they're able to go downstairs and they've got like a little bodega right there, or they've got a restaurant, or they've got, a clothing store or something like that, then now you've got a place for them to hang out before they have to sit in traffic for an hour or so going home. And they have something that they can do. They can walk around, they can enjoy whatever it is you want to set up. Think outside the box and don't see challenges as challenges. See challenges as opening up opportunities and figuring out what those opportunities are. That said, you've got a lot more to cover on that article, so I'm going to toss it back to you.
I was just going to say, around here, we've seen a couple of things that I've noticed. I'm sure it's that way in Florida as well, in other parts of the country. But I've seen a lot of commercial space, especially freestanding buildings, turned into churches and to private schools. The private school sector, especially here in Texas, the private school sector has exploded over the last 15, 20 years. When people have just, we're tired of the liberal indoctrination of our children that goes on in public schools. We're tired of a lack of quality of education. And so many of us have turned to private school. All three of my boys went to private school. And part of that is, where do they house those things? And as those schools get bigger and bigger, where do they go? And a lot of them we've seen popping up in former office buildings, retail spaces, those kind of places, especially if it happens to be a freestanding building. Just an interesting observation that you may be able to look at, okay, here's something I could do with a space like that. So to go on with our article as we're yakking about there, this doesn't mean when we have these rates pop up, this is something that Kevin and I both lived through, the Jimmy Carter policies. And as I've mentioned before, Jimmy Carter is Joe Biden's biggest fan on earth, because the Carter economic policies were the worst in American history until Brandon took office. When Brandon came in, he makes Carter look like an economic genius. So real estate transactions still happen, even though rates are going to go up. They're going to go up significantly. They're not slowing down anytime soon. And the industry doesn't stop. Will it slow? You bet. But they're going to continue to go up, and it creates this downturn. So the residential market's going to have a downturn in the majority of the country. The commercial market's going to have a downturn all over the country. Our rental market is going to continue to go up and increase. But when you look at this commercial thing, one of the things, or industry, one of the things that happens that compounds the matter of fact here is that when, as Kevin just mentioned, with so many people working from home now, it's reduced the demand for office space. So it becomes problematic when you're starting to look at B-class buildings, C-class buildings, especially those that have shorter lease obligations from their tenants, and they may not be in primo areas. They may not be in the prime locations of the market. So those buildings are going to take it hard. While it's still a lot of trouble brewing in the commercial real estate sector, there are some unique opportunities that still are out there. So Class A properties are still performing well, suggesting that there's still a high demand for high quality space. Office properties with leases of 10 years or more are more able to ride out market corrections like this. When I was at the ballpark in Arlington, the previous ballpark where the Texas Rangers played, when I was there for 14 years, I had a 10-year lease. And then when that lease started coming up, they only renewed for 5. And then they built a new ballpark right at the very end of that lease. But it was very common at that time when they first opened the ballpark, you could not get a lease shorter than 10 years. Why? Because they knew they were grade A premium space. And so those type buildings tend to weather these situations very, very nicely. And you get a bump in your rent every year, but it's spelled out in the lease. There's only so much they could increase the lease. And I think ours was 3%. So the office sector is going to continue to struggle, and a lot of investors are taking out of that, coming out of the commercial space and going into the multifamily space, going to the apartment building space. And they're taking over properties that the previous owners had paid high for and were getting low cap rates on them, specifically because it creates an opportunity for them to go in and add value. Geographically, Midwest is still a solid investment opportunity. This is according to Whitmore, the guy that runs that fund. Opportunity because of its slow and steady appreciation against rising rental market rates. There's going to be a lot of opportunities for experienced investors to take advantage of some of these loans. There's a lot of deals that are going to go back to the bank, and the banks are going to be scrambling to look at who's going to take those. Now, I know a lot of people say, well, if you saw news from Chase here lately, and I'm going to hold this Chase comment till we get back from break. We're a little over on our break here. So we'll be right back, and we'll talk about Chase and how this affects all of us.
All right, back in a minute.
Thank you for watching the Investor Guys podcast.
Live the resort lifestyle every day with Cayman K. The perfect pieces for every wardrobe. Shop the entire Cayman K collection and find your favorites. Find all our styles at CaymanK.com.
Absolution X. Lifestyle apparel like no other. Only at AbsolutionX.com. Get yours.
Thank you for watching the Investor Guys podcast.
We are back. One of the things, Bill, that I always wanted to do, and I actually have for years because I travel a lot, and I know you're familiar with these as well, is a virtual office space. And I have a company that for years I've been working with, and I can literally, in just about any country in the world, walk in and have a conference room or an office space to use on virtual office space because they have a network. But with the new work from home, we see a lot, this goes back to my real estate days, because when you're a real estate agent and you don't have a broker that you're walking into that office with all the time, or you've got an office that's super busy or an office that you just don't like or whatever else, you can have a conference room, you can have a meeting room, you can have mail, you can have phone, everything else in a great looking high-rise building in a neighborhood that you want, that's going to be your virtual office. You don't pay rent on that office every single month like you would someplace else. You walk in, there's a receptionist, there's someone who has your mail, you can get coffee, they usually have like snacks and stuff. They've got a common workspace. You can rent smaller workspaces like an office for yourself. They've got great conference rooms with video screens and teleconferencing and all kinds of other capabilities. If you've got a commercial space, you've got a whole floor, consider doing something like that, because that plays in perfectly with the people who work from home. A lot of times, especially if they're running a business or if they're an executive or something like that, they're still going to have meetings. They still need a place to get the mail that's not going to be their home address. They still need someone who can answer their phones when they're not around. And that type of a virtual office setting, like I said, I've always wanted to do something like that. The opportunity has just never presented itself up until now. But if you're looking at office spaces and you've got a whole floor, consider setting that up. And then you can work with some of these other companies, existing companies, to be part of their network, so that when people sign up for your service, they'll have access to those office spaces. And likewise, those companies, their members will have access to the office spaces and the conference rooms and everything else that you have as well. They do it all by appointment. It's not like somebody's going to walk in and be surprise. They do take walk-ins, but only on a space availability basis. But consider that as another option. I'm sorry, I'm swiping at a bug here because I got my windows open. It's like 90 degrees, but running the car with the air conditioner on. But that fits in perfectly with what we're talking about. I'll let it go back to you because I know we still got more article here before we get to the end of this.
So here's the important thing with all this. Is it a bad time to invest in real estate? No. Experienced investors know. Kevin and I know when the market's going great, we make good money. When the market's tanking, we make great money. So I bought my brokerage firm. I bought it in 2010. And my friends were like, Bill, do you see what the real estate market's doing? Why in the world would you buy a brokerage firm now? That's crazy. And I'm like, it's exactly when you want to buy. I don't want to buy at the top of the market. I want to buy as close to the bottom as I can. Now, I know enough about investing, period, to know that you'll never pick when the bottom truly is. If you happen to buy at the absolute bottom, go thank God, because that is just a blessing. That's not something you figured out. No one's ever been able to figure out the bottom of the stock market, the bottom of a particular stock, the bottom of the real estate market. We can all look back in retrospect and say, oh, that was the bottom. And by the way, 2010 wasn't the bottom for the real estate market. I just knew we were down enough. It was a great buy. And I love, still on it today, still operates today. Love having it. It's been a great addition to my real estate investing. So is it a good time to get started? If you're brand spanking new, absolutely. If you have somebody experienced like Kevin or myself working with you to keep you from doing something dumb that could cost you a ton of money. So this is a great, great business to be in. This is a tremendous time, best time we've had since the end of 2012 to get in, because you want to get in on the downward slope so that you're getting great value. Now, look, you got to understand, this is a long-term game. What do we mean by that? What we mean is that if you go back historically and look at the value of real estate, it is, so over the last 140 years, about when we have really good numbers on what the value of real estate was through all that time throughout history. And so over that time frame, we hit these dips. And obviously the biggest one was the Great Depression. Hopefully we won't see that again, but I'm not convinced that the Bidens are not stupid enough that we would get ushered into that again, because they have a different agenda and sacrificing the economy is just part of it. So if we get incredibly low like that, what happens is as we come out of that, what you will see is that prices are going to take off. They're going to explode and get crazy. There's a lot of places in Manhattan and around New York City where people don't blink. I mean, don't even think about blinking at $1,000 a foot to buy a piece of property. It's just like, oh, okay. A friend of mine recently sold a property in Las Vegas at $795 a foot. Now that's in the last month. But the stuff in New York's been going like that for several years. The rest of the country, as we come out of this, is going to readjust and prices are going to take off again. Now, it's going to be 3, 4, 5 years. This isn't going to happen next week. If we're fortunate enough, and my real estate attorney always tells me that, you have rights in America, and one of the rights you have is to be stupid and to make stupid decisions. And so if we're stupid enough to reelect another Democrat in the presidency, then we're going to get what we asked for. They're going to give it to us, which is not freedom, but prices will get destroyed for a longer term. I mentioned Chase as we were going into the break. Chase announced that they had $1 billion set aside with another $1 billion in reserve to go start buying foreclosures that are their properties. They provided the mortgage. If that property starts getting foreclosed on, they're going to maintain the property. They're going to take it and hold it. The owners are going to be gone. They'll have no interest in the property. Chase is going to keep the property. They're going to spin it off into a wholly owned subsidiary and start renting it. Along with about a week after that, UC Berkeley, or the University of California Systems, took $44 billion out of their retirement funds and said, hey, we're going to go start buying student property or student housing around all the universities. There's some economic forecast out there that institutions like that and like Chase, and look, if Chase is doing this, it's only going to be a matter of time. It's not going to be a long time. It's going to be a matter of time before B of A, Wells Fargo, PNC, and whoever the other one is that makes up the top five. The five big banks are all going to be doing this. And there's some economic theory out there that says these guys are trying to take us to a renter-based market, not a home ownership market. And that the goal is by 2030, which is right around the corner, it'll be here in no time, for them to have converted 40% of the current market that is single family ownership into rental property, to make us a renter nation with them controlling everything. Okay, you can call that conspiracy theory or not. I don't care what you believe. Just don't have your eyes closed as to things that are happening. Be informed. Go to a lot of different places and get information.
Real quick, Bill, this is what you do need to believe, though. Okay, if the trend is going this way, there is no reason why you should not be jumping on this trend at the same time, because you're not going to stop it. You're not going to buck it. Why do you think Chase is buying properties to rent them out? Why do you think that University Zillow's been doing this for years as well? Why do you think they are buying properties to rent them out? It is because that is a solid portfolio builder. That is a solid income strategy that grows year over year over year. So instead of pushing against it, instead of saying, no, that's not right, jump on the bandwagon. You know, it may not be right. And maybe the trend will change later on, and go out and buy your own home so that you become a homeowner. Absolutely, I believe you should. But if you see this trend going this way, and it's I honestly don't understand why they didn't do it earlier, because Bill and I have been doing it.
They missed it in 7 and 8.
What's that?
They missed it in 07 and 08, and that's what's happened somewhere after. So the market turned at the end of 12 and beginning of 13 and took off again. And somewhere between 12 and today, they were going, wow, we missed a great opportunity to absorb a ton of property, and we're not going to make that mistake again. So as this is happening, they are moving forward. They're not poised to, they're moving forward with putting that into place.
Yeah, and they have the deep pockets to do it. They're focused on single families, but we could focus on multifamily, and we are not going to be as far extended as if we had, say, 100 different single family units versus 2 multifamily properties that had 50 units in each.
Yeah. So it is a great time to start getting investing in real estate. Make sure you join us every week right here. We're on twice a week for the Investor Guys podcast. You can go to our website, investorguyspodcast.com, and see the archive of our 200 plus episodes, and catch up. They're all 20-30 minutes or so, and you can get a lot of information about investing, a lot of information about the market, the trends in the market, what to look for, how to look for it. And we just wish you guys happy hunting like Kevin and I have out there in the investing world, and hope you'll come back and join us next week.
Yep, and check out our website also for resources. And we are going to start putting up also additional articles. There's a handful of them there now. Bill and I are both going to be doing that, at least a couple of them a week. Check out that site for your resources. Start there and go on from that site to wherever else you're going to go on, whatever else you need. If you're looking for a resource, go there first. If you don't see a resource that you'd like to see, contact us. Let us know, and we'll find somebody that we know is a good, solid resource in that field, and we'll get it added there for you. Bill, thanks a lot. I will see all of you guys soon. Bill, I'll see you soon too. Good seeing you. Happy investing.
See you, everybody.